Thank you for attending the Cannabis Investor Webcast. Our platinum sponsors today is Cannabis Science Incorporated, Kaya Holdings Incorporated, Mentor Capital Incorporated, Nemus Bioscience Incorporated, Technical 420, Torigo Sciences Incorporated, and Pathogen DX. Please reserve the date May 23rd, 2016 for the Cannabis Publicly Traded Companies Investors, Analysts, and Media Conference. The website address is cannainvestorconference.com. Again, C-A-N-N-A investorconference.com. Our next speaker today is Chet Billingsley, CEO of Mentor Capital Incorporated. Chet, give me a couple of seconds to change the screen over to you and to unmute you.
Hello, Derwin, and fellow cannabis supporters and interested investors. My name is Chet Billingsley. I'm the founder and president of Mentor Capital. And when we discussed Mentor Capital in a previous webcast, we talked about the company in general. Today we'll review that just briefly, but focus almost entirely on our public company incubator program. You see on the chart on the right, Mentor looks to bring maximum public market value to cannabis companies as they move up the investment spectrum. We're not from the cannabis space per se. We're more a classic investment banking background, and were formed in 1985 after a regular corporate career with General Electric, and have focused on Silicon Valley and then the biotech space, especially in the cancer field. And I'll point out here that while in the cancer space, I was a registered investment advisor, meaning qualified by the SEC to advise a cancer hedge fund on its different investments. So we're relatively sophisticated when it comes to the public markets and people's investments in that regard. Perhaps because of that, we were rated as the leading investment and M&A firm in the cannabis space by Viridian Capital and Research. We won't spend a lot of time talking about our financials and overall performance in detail as we did in the last webcast. But I'll point out that at the end of 2013, our share price was 20 cents. At the end of 2014, our share price was 60 cents, and today our share price is 75 cents. On a normalized basis, that can be compared to the cannabis index, which at the end of 2013 could be normalized to 20 cents, moved to 18 cents downward at the end of 2014, and today would be about 12 cents. So rather than going from 20 to 18 to 12, we've gone from 20 to 60 to 75. What we're attempting to do at Mentor Capital is to provide normal investment banking and public company exit services and facility for cannabis companies. Now, normally, institutional investors have an expectation of investment safety. The founders and investors in a cannabis company are looking for liquidity at high public market rates, and the cannabis companies or the companies that are involved in an IPO and funding are looking at favorable rates and values for the funding that they receive. This usually culminates in the optimal case in an IPO a different spin that we've put on things to make it very attractive and to continue to be a dominant force in the M&A field in cannabis is we propose and will follow through with providing that IPO to the cannabis companies by doing a spin-off at cost. But there's a challenge, and this causes the need in this cannabis sector. One of the key components of that is that the marijuana-related management is often new to investment banking, public offerings, and IPOs. When I was in Silicon Valley, if you talk to any manager, and this would almost be an entry-level manager, not just CEOs of companies, but anybody, they probably would have known 10 people that had personally gone through and discussed with them the IPO process. And they would have already been approached, if they're more senior, by about 10 people on how to do an IPO, the rates, and customary approaches. Because this isn't common yet in the cannabis field, the marijuana-related management or cannabis-related management often is uncertain as to the way to go, and the results are less than optimal for them and often can be less than optimal for the investors. The institutional investors seeing this and experiencing different scenarios like we saw one time on a financial statement that the cash of the cannabis company was, quote, far and away. And this was just amazing. And the comment was, yes, we keep it where it can't be found or taken. Now, this may be required in an environment where the Department of Justice or Attorney Generals can step in and seize assets, but it makes it very difficult for institutional investors to step forward and say, yes, we're going to put our money up alongside this money that we're not certain exactly where it is. The people that do come forward with money to fund the growth of different cannabis companies often charge too much. We here get approached certainly every week by somebody that is interested in advancing us funds. The discounts range from about 30% to about 75%, and oftentimes are very toxic, meaning they can result in a death spiral for the company in certain circumstances. We never accept those financings offered, but some cannabis companies must because of the way that they're formed without adequate financing behind them. In order to prevent that, we'd like to provide normal financing, but that takes a degree of certainty that isn't manifest in many private cannabis companies. We feel if we can provide that certainty, we can overcome this challenge where much of Wall Street is just completely absent from the cannabis arena. And they'd like to get involved, and I've had many discussions with Wall Street investment bankers that are the higher tier firms that I've dealt with in the past, and they're interested in investing. They see that there's tremendous growth. I mean, the sector is growing at 40 to 60% per year. However, they're not ready to jump in yet because the certainty of their investment and the safety of their investment is not there. So our solution is to come up with a bridging period, a temporary incubator period where we bring in private cannabis companies and incubate them to get them ready for the public market. We maintain a degree of control that the institutional investors will interpret as conveying safety to them. We also have $21 million worth of warrants that will be exercised and come into the money as different private cannabis companies join Mentor Capital. That $21 million will be loaned out to the portfolio at 7.8% interest, which is a very reasonable rate in the current cannabis market. We also will allow for institutional co-investment, and this will be based on the financing needs of the cannabis company as conveyed by the cannabis operating management and founders. And if they feel that they could sell off 20% of their business to finance that, we will make that available alongside of Mentor Capital's investment, and institutional investors can invest into these cannabis companies. In order to do that, of course, there has to be a valuation, and we'll value the companies, the cannabis companies, as if they were a division of Pfizer. We'll talk more about that later, but we'll value the companies as if they were already as valuable as a portion of very good established companies. And as I said, we'll provide the going public action for the cannabis company at cost, and we'll make our money elsewhere by providing liquidity for the founders and investors. And I don't think that any other investment banking firm that is trying to provide reverse mergers, where usually a 10% slice is taken out of the private company, I don't believe that they can compete, because they can't operate and only provide that function and do it at no markup. The way we're accomplishing this is to start with a preferred share issuance. Now, as I said in the beginning, I was a registered investment advisor, and we're relatively sophisticated in this regard. And the reason that we're starting with the preferred share issuance is we want to get the clock ticking. The SEC will generally require a 1-year wait before founders and initial affiliates holding private shares can sell any shares they receive on the public market. So during this initial 1-year period of time, when we have to wait anyway, we issue preferred shares, and the preferred shares are really a holding pattern, and the valuation of the exchange is determined at the end of the 1-year period. This way we avoid the problem of my feeling and my evaluation here that the company at some particular period of time might be worth $1 million, where the founders feel that certainly their company is worth $250 million. That is just an impossible gap to bridge. But if the value is based on a formula, and the formula is based on the high values you get for a very good company, then we can let the chips fall where they may, and this preferred share structure allows this to happen. Now, this is not a trivial matter to set up. In order to accomplish this, Mentor Capital reincorporated and is completing that process, reincorporated in the state of Delaware, then has to get permission from the Secretary of State in Delaware to issue these particular securities. So it'd be very difficult for anyone else to duplicate this particular process. But at the end of a year, if the founders and investors in the cannabis company wish, they can convert the preferred shares into Mentor Common, which are freely trading at that time because the 1-year period has run out, and they can sell that in the public market. we have a formula for determining the value of the company. And that value grows as the company grows. So if a founder wanted to sell off 2% of his holdings at the end of the first year, and the company had a value then of $2 million, and then at the end of the fourth year he was going to sell off another 2%, but by then the company had grown by a factor of 10 and was worth $20 million, then the percentage that he would get, or the value that he would get for 2% now and 2% later, would increase by a factor of 10. If the company grows by a factor of 10, the value that the investor or founder can exchange for common and cash out goes up by a factor of 10. And the different people, investors, founders, maybe there's several founders, can convert their preferred shares into common at different times and different percentages. So one fellow may just want a new car and wants to sell off a little bit, and he can do that. Somebody else may want something more, and because they're buying a new house and want a down payment. And a third poor fellow may be going through a divorce and have to sell off most of his position. And different people can do that at different times and different percentages, much like after an IPO, holders of public shares in a company can sell at different times as they wish. In order to make this work, the company that is seeking to go public has to exchange 60% or more of their business into the going public pool that is part of MNTR Capital. That way we can assure that we have control that the institutional investors wish. When we have the going public action, it will be meaningful. And as a technical point, MNTR Capital can stay an operating public company as opposed to an investment company, which has many other constraints. A secondary purpose of our action is to provide funding for the private companies. As I said, we have $21 million worth of warrants to be exercised by 5,000 shareholders progressively as our share price rises. We'll loan those funds to companies in our portfolio. That's one way they can receive funding. A second method is we'll invite institutional investors to co-invest with us for cash according to that formula, and the different cannabis companies and founders can opt to sell off for funding 10%, 20%, 30%, or whatever portion of their company they wish. To give an example of the returns we're looking at, we would offer a 17.8% discount across the first year, meaning if somebody invested, say, 6 months before the end of the year when we have the first full valuation of the company, we would give them half of a 17.8% discount because their 6 months is half of a year. And whatever the value at the end of the year was, that first year of valuation, they would have a discount, in this case, of 8.9% from that. And any investor can get liquidity after the first year. Now, that makes it much easier for the cannabis company to close any final fundraising that they're interested in doing. Because rather than saying you're investing in our cannabis company, our private cannabis company, and we hope to go public in the future, they can explain that they are looking to go public in the future, that is pre-greased with Mentor Capital's public incubator program. And if the investor changes his mind after 12 or 13 months, they can exit through an exchange of the preferred shares that they will also receive into Mentor Common, and then sell that freely trading public shares on the open market. In order to entice the institutional investors that today are not really participating much in the cannabis field to have confidence that they can invest through Mentor Capital in a pool of high-quality private companies, we established temporary control during the incubator period. Now, we have never run any of the companies that we invest with in the last 30 years, and we've been doing this for 30 years. It's just not what we do. However, in this case, we will make sure that the institutional investors have a high degree of confidence, because we'll control the accounting of the company. And I can assure you, we'll not be saying that money is kept far and away. It'll all be done in a very regular basis. Feeding off of that, we prepare audits for ourselves, because we're a public company on the OTCQB and fully reporting with the SEC, and hence we'll be preparing subsidiary financial statements for the portfolio companies. We also put in place banking controls, so there's not any funny business that is not expected. But if the institutional investors don't trust that it's safe, they won't put their money into that bank account. So we make sure that the banking accounts are controlled. And we prepare the board for the public market to make sure it has the right makeup, the right articles of incorporation, and so forth. And during this incubator period, we're controlling the board, and the institutional investors can have a high degree of confidence that nothing is going to go astray under our watch. The value is then reevaluated every quarter, and this is the value that investment money comes in at, that the founders and investors can expect, and that if there's any cash out, it goes out at, until the IPO itself, when wherever the chips fall, that's where they fall. We don't give any value for hype, and some founders may find this irritating, because they just know that their company is worth a tremendous amount. I personally have had serious discussions with founders, and have had 3 founders, each with sales less than $2 million, each explain seriously and convincingly to themselves that their company is worth $1 billion. And we just can't allow that if you're a rational investor. So we give no value for hype. We only give value for sales and earnings. And that's verified by our audit process. Once the company comes in to our incubator program, and the accounting is monitored by us, and they go through the audits, we know what their numbers are. And we've set up a mix of substantial and high quality public companies that we think are representative of the cannabis sector in general. That's Pfizer, a pharmaceutical company, Coca-Cola, a brand, Anheuser-Busch, an alcohol company, and Philip Morris, a cigarette company. And we've blended those to come up with a valuation formula that would be appropriate for a high-quality cannabis company. And that formula then works out there that you see, and it increases if there's more cash and decreases if there's liabilities. And I should add that value increases as the sales and earnings increase quarter by quarter. So it may be that a fast-growing cannabis company has higher growth, and then there's an argument that there should be a higher valuation, and we capture 100% of that growth by allowing the value to increase as the quarters roll forward. In the process of actually taking a company public, we're setting up the audit, the financials, the board and officers. All of those are groomed for the public market, either through loans from MNTR Capital or from outside institutional investors. Adequate financing is already in place at the time of a public spinoff. And we do this at cost, and we recover our particular legal or audit costs with no markup. However, we don't take anything more than has been sold to us or that we have purchased. So if 100% of a company's private stock was exchanged for preferred shares, and over time 17% was cashed in, then that piece has been sold. That will be owned by MNTR Capital in general, because MNTR Capital have issued their shares to the private cannabis company founders and investors. And 83% of the preferred would be retained by the founders and investors of the private cannabis company. So then, at the time of a spin-off IPO, 83% of the stock in the IPO will be held by the original founders and investors. And the 17% that was sold will be given as a special dividend to the 5,000 shareholders of MNTR Capital. That creates, at a very low cost, the public company that can then be spun off and operate independently under the control of the original founders and original investors in that private cannabis company. The results of this are the timing is determined by the founders. We don't drive the company to be spun off. That decision is made by the founders of the company. The financing is pre-delivered. They're not launched like in many reverse mergers with all the burdens of the public market, but none of the financing in place. A result of that reverse merger approach is that the company is desperate for cash, so has to sell shares. And when they sell shares, they're going to do that at a discount and drive down the share price. If you're an investor, you see the company go public and then see the share price go down. In this case, this is a pre-financed public company, and in addition to having the pre-financing, it'll have 5,000 cannabis-interested shareholders. And that's a much better position to be in than in, say, a reverse merger where you might have 300 to 500 gold mining investors that see that now they've become part of a cannabis company. We do that at cost, and don't believe that anyone else can match that, because that's the primary service they deliver. We, on the other hand, are providing liquidity for the cannabis companies over time, and that's where we make we pick up our ownership that has growth, and we make our money on that piece. And we do this without requiring an extra 10% slice that is often required in a reverse merger. What that means for the individual shareholder in Mentor Capital is that where they may have started with 40,000 Mentor Capital shares, each time there's a new spin-off, they pick up shares in that new cannabis public company also. So they may end up with 40,000 Mentor shares, that doesn't change, but then additional public shares in company A, B, C, and D as those are spin-off. Now, some companies will enter into this program and expect to go public and expect that their sales will be in the 20 or 30 million range, but find out later that it's harder than expected and their sales are only in the $2 or $3 million range, and that they would just as soon stay inside the Mentor Capital portfolio because they can exchange their preferred shares for Mentor Common anyway and sell off Mentor Common based on the formula. And there's no need for them to go public at such a small size where it's not economical for them. Those remaining companies, we'll call them private companies in our portfolio, just increase the value of Mentor portfolio holdings. So this program results in two things: either extra public shares issued to Mentor shareholders in new cannabis companies that are just coming out, or an increase in the Mentor portfolio holdings. And we think that will keep Mentor Capital a dominant performer in the M&A and investment space for the cannabis market. Thanks for joining us, and I'm happy to take any questions people may have.
First question, Chet, what is your criteria and key metrics used to decide to invest in a cannabis company?
We look at the legitimacy of the business. They have to have serious management, sales, and earnings. It may be such that they don't have earnings today, but we have to see that there's a possibility that they are going to have earnings in the future. So we look for management, sales, and earnings, and sometimes it would be very hard for anyone else to judge this if there is synergy with existing companies that we already have in the portfolio.
Okay, the next question. Let me see if I can read this question correctly. What is cannabis owners' average percentage of ownership at public offering? So I guess what percentage do the cannabis owners, the founders of these companies, what do you estimate, by the time they do a public offering, how much left of the company do they own? Is it 10%? And I guess it's just an average or an estimate.
Sure. Well, this is up to them. Now, in our formula, they start with 100%. And only as they sell off some of their holdings does that percent decrease. So they exchange some of their preferred shares for Mentor Common and sell that and put that cash in their pocket. Often the founder and key management sell off virtually nothing. maybe just a few percent. But the original investors that may have invested, I'll just pick a number, may have invested at 20 cents, and now their share is at $2 because they've been in for 4 years and they'd like to get out as quick as they can. A lot of times those original investors or seed investors, they get out 50% or so. But this is completely up to the individual investor and founder. We don't require anything unless they want to sell for money or receive financing for money. And then that is always based on the formula.
Okay.
I might add, to make it easier to calculate, that if the multiple is 20 times after-tax earnings, a company or a founder could either take all of the after-tax earnings and put it in his pocket, and he would have the complete earnings for 1 year, or he could sell off 5% of his holdings and get the same amount of cash and put it into his pocket. So it's a lot easier to sell 5% of the company than to take every dollar that's made, allowing no money for growth, and to pocket all of that. So the high value makes it very attractive to sell off not a large percent, but a small percent of the business as you're ramping up to a public offering.
Okay, Chet, our next question is from Paul Grubb. Paul, I think you do have a microphone, so you can ask your question if you would like.
I just wanted to ask, what is the process for an individual investor to buy the preferred stock today, or is that even possible?
Yes, just at it. I have to be careful here. We are not soliciting for any investors at this moment by this presentation. I'm explaining more to the companies that are seeking investment, the process that investors will come to them through us. However, if any investor wanted to explore that further, they could call me directly offline and we'll talk about it.
Thank you.
The next question, Chet, how do you determine initial investment? So I think the question is, you establish valuation is determined by actual revenue and earnings, but how do you determine initial investment?
Well, remember, our primary purpose is providing long-term liquidity. We might loan money to a company. We certainly will invite institutional investors to co-invest with us, and we would ask the founder, what percentage of the business would you like to sell off? And if they say 20%, then we project a value which will be determined at the end of the year, and determine what the discount is, and then say, okay, we'll based on that number, it looks like you're looking for $540,000. And we'll make that available to institutional investors, but rarely do we put down money and say, here's the money, we're buying a percentage of your business. The reason being is we've found that that's very risky in the cannabis market, and we only do that when we've established a solid value and controls, because this money, it isn't my personal money. It's always money that comes from investors, and we make sure that that's controlled. So that the initial setup is the 1-year period determines the value, because the person asking this question, how do we determine the initial payment, let's say, that will end up being a determination of value, and that there's always this big gap between a optimistic plan and today's reality. So we avoid that and take that out of the equation by saying we're going to determine the value at the end of 1 year. As money comes in from the exercise of warrants, we will allocate that as we wish to the portfolio. If a company is performing and growing, we'll know that after just a short period of time, and it's in our best interest to get money into their hands, because ultimately that will redound to us as some percentage of their business redounds to us through an exchange of common. And we want that growth. And besides, it's a loan, so it's going to come back to us anyway. But we generally do not make a down payment on the first day, because we're here to take a company public over time. Much like if you go to an investment bank and you'd say, we'd like to go public, and on the first day they don't say, great, we're going to give you $1 million today, and then we'll take you public over the next 9 months. We're more an investment bank taking companies public and providing liquidity along the way and arranging financing along the way, not a venture fund that comes in and plunks down money. However, a large advantage of us, or working with us, is when a venture fund does plunk down money or is considering that. Anybody working through Mentor's incubator program will be in a position where that venture fund can cash out in as little as 1 year. And that's a huge advantage, as opposed to waiting till some eventual later public offering that may or may not come, as far as the venture firm is concerned.
The next question is, what is the most important hurdle for the cannabis industry? Public banking or government removal on the Class 1 drug status?
The biggest hurdle is the government. Now, the government indirectly is causing the banking issue. The government is causing the uncertainty in the market for investment banks and Wall Street, and the government causes the uncertainty of will that Schedule 1 drug status be removed or not. So the biggest hurdle is government acceptance generally, and I believe or project that the big change will come with the 2016 elections, where several states, probably including California, will step up in the legalization, and this will put sufficient pressure on other government organizations that will get a change to the better in the cannabis space. So it's the government generally. The banking thing is quite a problem, but of course that's government driven.
Our next question is from Rita Powell. Rita, I think Rita has a mic. Rita, you can go ahead and ask your question. Rita?
Yes, Chet. What percentage of the business has to be cannabis related?
Well, we have to feel that it is sufficiently cannabis related that it is, it's dominantly cannabis related. Now, a lot of times, people that are entering the space used to do something different. For example, a laboratory. So a laboratory used to look at all sorts of biological contaminants and so forth, and on the first moment, their involvement in cannabis is 0. And then as time moves forward, that percentage increases. And as long as there's a commitment to the cannabis space, we can work with someone. Usually that has to be determined on a case-by-case basis. But if somebody is 80% oil wells and just says that tomorrow they have a cannabis division, we wouldn't work with them.
Okay, thank you.
Next question. What is the status update of the money funding used for Bang Chocolate? When do you expect to get that back?
Yeah, it's a relatively straightforward case in my mind. We gave Bang Chocolate $1.5 million and $7.5 million in freely trading shares, and they decided that they didn't like the transaction that they had signed just a few months earlier, and gave back the shares. Did not issue us any percentage ownership, and said, well, and we're going to keep the $1.5 million. At that time, their total sales were about $800,000. So this seemed an outrageous breach of contract law as far as we were concerned. We sued them in federal court. It was referred to arbitration because there's an arbitration clause. And at the moment, we're selecting arbitrators to settle this. We think there should be 2 judges and an attorney. They think there should be 1 judge and 2 attorneys. So we're at that stage. These things tend to go forward just as slow as molasses because it's the legal system. But I don't see that there's any argument on the other side. If you give somebody $1.5 million and they give you 0, then it's really tough to say that that was a fair deal when there's no provision in the contract for anything like that. So I expect us to recover the cash, the attorney's fees, and interest. It's not something that we need. Let's say it's of course very nice to have, but it's not critical to our existence at all. And we'll just continue to march forward and then collect on those funds. And certainly Bang is large enough that there's assets there for us to recover, so other people will step forward to somehow the judgment would be met.
Yeah, it's pretty.
So,
yeah, it looks really good.
Yeah, I think the results look very solid. However, slow, just as you normally expect.
Our next question is from Alan Brockstein of 420 Investor. Alan, go ahead and ask your question.
Hello, Alan.
Hey, Chet. How are you?
I'm doing great. Keep up the good work. I love your column all the time.
Thank you. I just had a question about waste consolidators. Is that
sure?
Do you consider that a core business, or do you have plans to dispose of it?
Well, yeah, we're looking. It's a private company. We've groomed them forward from $1 million in sales to a couple million in sales. Now they're moving forward from Phoenix into Texas, and they're very profitable. And so we would like to sell that business and then take the cash generated and invest it into the cannabis field. They're private, so it's a little tricky to do, or it's not something that's going to happen very quickly. And we're not making any announcement in that regard by this phone call. But certainly we want to become a pure play in the cannabis sector.
Thank you.
Chet, I think that concludes our Q&A session. Any last comments?
There's two ways to run a public company. It can be run for the benefit of the insiders, or it can be run for the benefit of the shareholders. We focus on increasing our share price, and if you track that metric and you're an investor, I think that you will do very well. And I expect that you'll see only that in our future. And I look forward to seeing anybody's new names on our shareholder list.
Thank you, Chet. That concludes our presentation.